Good afternoon, everyone. I'm Lorraine DeBono, Managing Partner at FLG Partners, which is the leading interim CFO and board advisory firm in the United States. We serve clients globally. Welcome to our 11th edition of CFO Insights. And today we're really happy to have FLG partner Monica Stevenson join us for lessons learned by a consumer CFO in the luxury market. Before we begin, let me tell you a little bit about Monica and her background. She joined FLG in 2020 with over 20 years of financial experience and over a decade of specialized expertise in consumer and luxury goods, apparel, beauty, retail, wholesale, and e-commerce. As a CFO, she has led a diverse set of functional areas, which include finance, operations, treasury, real estate, legal, risk management, you name it, for the North American operations of global brands such as Tornio, Versace, Yves Saint Laurent, and Dolce & Gabbana. So welcome, Monica. We are delighted that you have joined us at FLG. So Monica, let's get to our first question. So prior to joining FLG, you spent 20 years of your career working for consumer companies, both private and public in luxury goods. Give us a snapshot of a few of the key roles you've had during your career and tell us a little bit about what you believe you accomplished in those roles.
Well, first, Lorraine, thank you for that wonderful introduction. You're absolutely right. Prior to joining FLG, I spent over 20 years working for some pretty large global iconic consumer brands. And as you pointed to, I've led not just finance and accounting, but also several operational areas of the business, which have included human resources, IT, merchandise planning, which was one of my favorites, legal, treasury, and corporate operations. My experience has also, as you pointed to, included working with global brands that had international headquarters abroad, namely Europe and Asia, as well as global brands that were headquartered here in the US. And not to leave it out, I've also worked with domestic brands that had zero international presence whatsoever. I also have spent a great deal of time working with private and private equity, as well as venture-backed businesses. I like to say that most notably, during my 4-year tenure with Yves Saint Laurent, we were faced with an economic downturn of 2008, 2009, if we can all remember that time period. To say that it was a challenging time for luxury is a complete understatement. And to further complicate matters at Yves Saint Laurent, that was a recent acquisition by the holding company that also owned several other luxury brands like Gucci. Their plan for the business was to take what was a very high potential brand, but that was operating at a loss, and scale it to profitability.
Tough.
Very tough. And the economic downturn did not help at all. And however, while it was disruptive to our scaling plans, it did present a massive opportunity for me personally as a CFO. I was able to team up there with a quite visionary CEO who placed finance at the forefront and core of all decision-making.
Now that's a rarity to find a visionary CEO who places finance way at the top. They normally don't at all. So good for you that you had that great relationship. Keep going.
Yeah, it truly is rare. And I was able there to help to orchestrate what was a comprehensive turnaround plan that involved collaboration across all of the company teams, from the buying and marketing teams to the visual production and sales teams. And my involvement even extended to traveling with the buying teams to the runway shows, which was quite fun.
Yeah.
But it was all business because I was there to help align the buying plans with the gross margin targets for the business. Against all the odds of that time period and a downturn market, we successfully achieved break even. I'll give another example of some of my experience. Quite similarly, when I assumed the role of CFO for Versace North America, and North America was the largest division for the Versace group, that group had been grappling with over a decade of annual losses that had well exceeded over $100 million. Every single store, and we had plenty of them, was unprofitable. Over my next 4 years there, we not only restored profitability to every single store, but we tripled revenue, increased our margins by well over 1,500 basis points. We launched e-commerce, and we positioned the company for a successful sale to Blackstone.
Mhm.
My responsibilities there span strategic planning, finance, accounting, operations, HR and IT, merchandise planning, and I even had e-commerce under me for a while.
Mhm.
One other notable thing during my time at Versace was they were under a very arduous tax audit when I joined with the IRS. And we were able to successfully retain over $100 million of net operating losses, which we were then able to successfully apply towards future taxable earnings.
Those are amazing achievements. And you said something, I'm looking at my notes about how you were able to, I think this was at Versace, you were able to travel with the buying team to runway
Yeah.
shows to align the buy plans with gross margin growth targets. I mean, you got to do that, right? To make for sure that the business is going to be profitable.
Yeah.
So that was a really interesting nugget that you gave there. So again, great achievements.
Thank you. I like to say that, Lorraine, throughout my career, whether it's been at those aforementioned brands or later at brands like Tourneau or MCM, my role as a CFO has been marked by creating and executing successful operating strategies, which has led to profitable growth. Beyond that, I've also been entrusted with bringing practices into the organization that has helped to nurture high-performing teams.
Mhm.
And I don't want to leave out what I've been up to since joining FLG. I've had the amazing opportunity here to begin working with VC and PE-backed companies of varying sizes, also in the consumer space. And some of my clients have included brands such as Henry Rose Fragrances, the House of LRNC, and Creed Fragrances, which was pretty exciting and an extensive post-acquisition integration. And I would be remiss if I didn't mention that I began my career as an auditor with PricewaterhouseCoopers in their consumer product group, where I gained invaluable insights and best practices that continue to influence me today.
Again, you've done some very challenging, is what I would call it, work, both strategically and operationally. So, hats off to you with that. That's terrific. So, tell us a little bit more. So, during your career, you've worked, I know, across geographies and cultures to implement new business processes at a number of international luxury companies that have had global operations. So, how has that, Monica, framed your perspective as a CFO?
Well, that's a great question, Lorraine. I believe that what distinguishes my background a bit as a CFO is that I have held these financial leadership roles at global brands with international headquarters outside the US, again, namely in Europe and Asia,
Mhm.
in addition to the roles where the headquarters were in the US, where I sat. So, for example, in my role at Versace, Yves Saint Laurent, and even at MCM, the global headquarters were based in Milan, Paris, and South Korea, respectively. As such, my responsibilities extended beyond the standard CFO duties. While I was managing up and down across the North American region and division, I had to also make sure that I was synchronized, that my domestic strategies were synchronized with the global headquarters' overall goals. And at time, I had to also educate those global headquarters on the North American market idiosyncrasies, all the while maintaining crucial relationships with my counterparts in the global CEO and CFO seats. And last but not least, there is, of course, when you work internationally, the added complexity of working across varying different time zones.
Mhm.
While working across all these geographies, I like to think that different cultures have truly shaped me to be an adaptable leader. Each country, be it France or Italy or APAC nations, comes with its own unique working styles and communication preferences. And I've had the privilege of collaborating with colleagues in all of those regions and while leading the US teams and reinforcing the importance of staying open to a diverse approach.
It's so interesting, that whole concept of adaptable or adaptability or the adaptable leader. And clearly your multicultural experience, I think, has allowed you to become adaptable in your work. And it's kind of like a superpower. So what I would just say for our audience is, to the extent that you in your career, right, can get similar cultural experience like Monica has, it can only elevate your career. Absolutely.
Yeah. Yeah, understanding the nuances of different geographies. it's quite important. And I've learned to proactively inquire about preferred working styles of my key counterparts as one of the very first things I do. I won't explicitly go into what some of the differences are between, let's say, the French and the Italian cultures when it comes to work environments, but you probably can easily infer that there are some differences there. The experience of working with a Korean company was actually really, really interesting as well. And what I found really fascinating there is that with Korean companies, they actually place a huge emphasis on the employee's tenure and age, often on par, even more than their job title. And I actually found that to be not just interesting, but impressive and quite humane to put so much value into someone's tenure and age. Beyond adapting my leadership styles, Lorraine, to different cultures, the international exposure has provided me with a broader perspective on the consumer industry. For example, observing the performance of a business across US, Mexico, Europe, and Asia, all at the same time, has been quite invaluable. And it has often served as a lens for me to identify additional potential for my division or foreseeing impending downturns early on. I have a really interesting example of that. So while at Tourneau, we had a very small European business while I was there. And that business, out of nowhere, started showing sales trends that were really trending up, comping some pretty impressive numbers. At the same time, our US business was trailing down. And we were quite concerned, obviously, because the US was our core business. So as we tried to get a handle on this, what it unveiled to us was that the impact of global pricing disparity between the two regions was actually driving the consumer to start purchasing their timepieces while they were on holiday in Europe due to the
Makes
favorable
sense.
exchange rates.
Totally
Yeah,
makes sense.
it totally made sense. So once we were able to identify that, we were able to put in place strategies that helped to further bolster our European business and then to look at ways to also offset the downturn in our US market. So I say all that to say that having a global perspective not only encourages, but ingrains global thinking. It makes sure that you ensure a proactive and informed approach to maximizing your shareholder value across all things at all times.
Could not agree with you more. That's great information. I love your examples of the businesses that you've worked with. So now let's pivot and talk about something else, which is raising capital and the unique challenges felt by consumer companies when trying to obtain financing for growth, particularly in today's tough capital markets. We know it's been tough out there for the last 2, 3 years.
Yeah. I mean, this is a really hot topic. I think everyone has it front of mind. Raising capital for consumer brands in particular it presents its own distinct challenges. And my current experiences with two clients underscores these complexities fully. One of my clients, Lorraine, was initially aiming for an equity round of financing, but faced a pretty significant hurdle when the interested investor unexpectedly altered the company's valuation to a mere 1.5x, when very recently the company had a very stark and contrasting multiple of 3x. The investor then, after us negotiating back and forth on that topic, withdrew altogether without any clear expectation. And of course, this left the company in a really difficult cash situation. I've had another client that most recently raised a round of equity this previous spring, and they didn't raise enough. There was offers out there for them to raise more, and they didn't think they needed. Mistake. And then they found themselves in need of additional capital very shortly on. However, the lead investor came to the table again, but offered them very, very different terms just a few months later. And those terms were less favorable, obviously, to my client, more favorable to the investor. And all of this was despite the business actually faring and performing quite well. So, I mean,
and I just to
yeah,
add just to add there, that's happened actually in all sectors right now, where you have investors who understand the moment of tough equity financing and want to jump in at setting much lower valuations, cramming the previous investors down. And uh, as you said, despite the business, be it in life science, med tech, consumer products, or general tech, doing relatively well. So we've seen that a lot over the last
Yeah.
year.
Yeah, I don't want to liken it to what's the term, like they're sharks that, they smell blood in the water. I don't want to go that far, but I think there definitely is a much more opportunistic nature that's
Absolutely.
happening right now that
Absolutely.
investors are taking advantage of. And it is really having a detrimental impact for some of my clients in particular. Um,
Absolutely.
I I think with consumer companies, they face their own unique challenges, and in particular, they must prove their distinctiveness and innovation to investors. And that's difficult sometimes in a market that's quite saturated with competing brands.
Oh, yeah.
Um, the emphasis is more on being not just another widget, and that's crucial because investors are growing quite wary of crowded markets, making it essential to clearly articulate your brand's unique selling points, your target audience, and your market positioning, along with competitive advantages like an innovative product or a robust customer loyalty program and a unique market niche.
I would completely agree with you. Uniqueness is really a key right now in the consumer space. And then how do you build that into bringing out products that you can engender robust customer loyalty and things like that? It's tough right now for consumer companies. I totally get that.
Yeah, it truly is. And also keeping up with, what the interests are of an investor is also difficult. So a few years ago, not so long ago, a lot of investors were looking at ESG. That was the buzzword. They really wanted to invest into sustainability and brands that had social responsibility at the core of their
Mhm.
offering. And investors saw that as an attractive investment focal point. But the current market landscape, I'm seeing a lot less of that emphasis today.
It's very interesting to me how fast ESG has like literally faded as a focal point for investment. It's just not there anymore. It's really quite interesting. Mhm.
I agree. I think investors are now seeking profitable businesses at the
Totally.
forefront of all other things.
Mhm.
They want to see that a business can demonstrate scalability, and this expectation around profitability has become almost a prerequisite for their
Mhm.
investment.
Or at
When
least
it
a path, or at least a clear path to profitability, right?
a clear and very short path
Yes, yeah.
is what
There
I'm
you go.
seeing. Um, as it pertains to D2C, our direct to consumer business, I think those businesses are facing additional challenges because they're also grappling with the escalating paid media and consumer acquisition costs. So crafting a compelling investment proposition under those circumstances is becoming a bit of a formidable task, if you know what I mean.
Absolutely.
Um, Another trend that I've seen as I've gone out to raise money is that investors are looking for channel diversification.
Mhm.
And by that, they want to know that you don't have all your eggs in one basket. From the consumer standpoint, that means you are playing in two of the three areas: retail, wholesale, and direct to consumer.
Mhm.
But it's notable that achieving this requires significant capital up front to fund the inventory, especially if you're getting into a wholesale distribution channel for the first time, where the inventory to cash cycle is notably longer than your D2C or your retail
Mhm.
cycles. So what I've seen, Lorraine, in response to these challenges, and I've seen this both at current and prior clients, they're exploring alternative financing options. They're looking more at securing bank loans. Typically in the consumer space, that's an asset-backed loan that's
Mhm.
tied to your inventory or your receivables. Some are even looking at traditional term loans because navigating, this current landscape, it's quite intricate and it's demanding strategic thinking and an adaptive approach.
Those are great insights, Monica. Thank you for that. So we're going to pivot again and talk about uh, post-acquisition integration. So I know you've been right at the center of several of these post-merger, post-acquisition integrations. And why don't you tell us a little bit about, what you've learned as a CFO who leads these efforts?
Sure. Being at the forefront of multiple of these type of efforts has provided me some invaluable insights about the complexities that are faced both by the acquiring and the acquired company. So there are some challenges on both sides. As a CFO leading these efforts, I believe that a strategic and meticulous approach is essential. It truly is the only way to ensure a seamless merging of both entities and to ensure sustained financial success. I have a pretty recent example here, and it's with Creed Fragrances, where Creed actually acquired the US independent distributor. The name of that company was International Cosmetics and Perfumes, very long name, so we just refer to it as
Just say
ICP.
ICP.
It's ICP. I was brought in to play a crucial role in that integration of Creed with ICP. And some of the key insights from this, as well as other integrations I've worked on, is that you first absolutely must prioritize financial transparency. Remembering that financial transparency is a guiding principle throughout the integration process, and that the need for it is probably at its highest directly after the acquisition. And the reason for this is, the acquiring company is really working to get its arms around the key metrics and drivers of the business that they just acquired. So it's obvious why, really having that financial transparency is important early on in the acquisition. And another takeaway that I've found to be true throughout these processes is that you want to ensure open communication with the acquiring or acquired company's team. So the two teams almost need to work symbiotically as one. You want to make sure those lines of communication are open, minimally with the CFO and the finance team, to ensure a seamless integration. Another thing that came up with the Creed integration was the need to take a proactive stance on any items that were lingering from the due diligence process. Any items that are there, you will want to, one, know about them early and make sure that you identify and address them with and present an action plan to the acquiring company with aligned timelines, because generally you want to get those things resolved quickly. I also want to, you will also want to conduct what I consider like a thorough financial analysis. And this is not a full audit. There probably would have been an audit or one coming very quickly after the acquisition, but you really want to get in there as a CFO and gain for yourself a comprehensive understanding of their financial statements, because that is crucial. It really helps to enable identification of insights and opportunities that can be shared with the acquiring company.
Absolutely. Absolutely.
Yeah. You need to understand also the full scope of the financial structure and the people, which is really important. You really need to assess the financial capabilities and the operational gaps, whether it be in the people or the accounting systems or the reporting requirements. In addition to identifying the risk or gaps, you want to understand the synergies as well, and any necessary adjustments in team size, whether it's a plus or minus to the headcount structure.
Mm-hmm.
I think you'll learn a lot through just going through that process of understanding doing a financial analysis of the people processes. So again, with Creed, it was really interesting because one of the things that I learned as a takeaway very immediately from doing my own financial analysis was that there was a lack of robust monthly closes at ICP. And as a result of that, they had very limited financial reporting and little to no historical data was available. And we really needed to look back several years to try to cobble together the historical financials. And they also had, I mean, it's no wonder that they had a multiple of due diligence issues. I mean, they didn't have solid closes and financial data. So there were a host of due diligence issues that were brought up, and they were pretty extensive. Some involved international tax matters, and they were also quite time consuming than the acquiring company had initially thought it would be to resolve all of those due diligence issues. And the last thing, this was a recent acquisition. And so all of this was happening in the midst of a shifting macroeconomics around the business that really seemed to onset right after the acquisition. So any one of those issues in an acquisition would have been a challenge, and we had all of them. But despite that, in the end, a successful outcome was achieved, and mostly due to the strong communication and strategic alignment between myself and Creed CFO, as well as having a very close collaboration with a very capable senior controller that worked with me through this integration.
So I have a question for you, which is, I know you have left the business now to do obviously other consulting work, but how is the business going? Do you have any insight currently into has the success of the initial post-merger integration continued?
Yeah. Yeah, well, yeah, I keep up with them just because I like to hear. And it's also good because knowing what any one brand, how they're faring helps to inform,
Totally.
brands that I'm currently working with. So they have had a pretty good post-acquisition experience. So
That's
one of the
great.
things that we did while there was we corrected all of the wrongs of their reporting. And that was the KPI reporting and the financial reporting. And so they have better tools now to really help them react more quickly to the shifting macroeconomics around them. They also, more from a branding perspective, they had a really successful launch of a new fragrance. So I think, those two things
Good.
together, like having more insights into the business and then having a super successful launch of a new fragrance, those two things really help to propel them, I think, excite them for, how they are to fare in a post-acquired world.
Sure.
Yeah.
So I know you
Uh,
have 5 key points for CFOs that are involved in an acquisition integration. So let us know all of those.
Yeah, sure. So some of it goes back to what I've already said, but I'll summarize them a little more briefly here. The first is you will want to cultivate a strong partnership with the acquiring company's finance leads. So the CFO, but not just the CFO, that entire team, because generally it's not just two CFOs working on the integration, it's both of those finance teams. So you want to make
Right.
sure that that partnership is there. The second thing, Lorraine, is identify the necessary resources and talent required for the integration. And sometimes that may mean additional hires because there is a
Absolutely.
lot of work that goes into integrating two
And you
companies.
and you start finding all the talent gaps. Absolutely.
Yeah, yeah. The third thing I like to point to is you want to align the financial reporting processes really early. This helps you to minimize any disruptions in reporting down the road. And then the fourth thing is address disparities up front. And that will also help you to prevent delays in financial reporting or regulatory reporting or both. And the very last thing I would say is be proactive. Be proactive about your communication, but also the due diligence, the financial transparency, and the sharing of all KPIs. I truly believe that if you follow those 5 steps, it will contribute to a successful integration and unlock the full potential of the combined entities.
So I think you've just given great advice to our audience and CFOs when doing an post-merger, post-acquisition integration. I mean, integrations typically are tough. I've done over a dozen in my career, and most of them actually fail. So I think you've given a nice playbook to our audience in terms of how to do it right, so to speak. So let's pivot again and talk about working with PE firms, which I think is going to be even more and more for consumer-based companies going forward. But CFOs, when they are in consumer companies, often need, as we know, to work with PE firms as investors in board meetings. And they can be very tough, very rough, actually, on the CFOs of those portfolio companies because their demands can be formidable. And oftentimes, financial statements that are needed by the PE firm for their investors differ, perhaps from standard GAAP accounting or whatever. So, in your experience, what do you see as keys to success, Monica, when working with PE firms?
Yeah, well, it is true that working with private equity firms or their board members can be dynamic and challenging aspect for CFO in a consumer products role. with a PE sponsor. Personally, I've experienced both private and private equity company environments. And I actually, and this might go against what other CFOs think, but I value the contributions that a PE firm brings, not only in terms of their financial support, of course, but also their strategic insights. I think that building a relationship with the PE partner can actually be a valuable asset to a CFO and offer strategic advantages. I mean, minimally, PE firms, they have a whole portfolio of other companies. So minimally, you should be getting insights on how other companies are faring from them. I'll give another example of where this has served me. So when I was working with a PE firm, and it was the first time that I was faced with the task of raising a convertible debt note. I had never done that before. However, I was able to closely collaborate with the operating partner of the PE firm. And in addition to leveraging their expertise throughout that process, it helped us to actually build a foundation of trust. And so I've walked away generally in working with PE firms with some key strategies that I find to be successful each time I go into a new portco. The first one, and it's an obvious one, it's clear and frequent communication. Be transparent. I strive to actually have open and honest communication with the PE firms and their board members because I know that this transparency helps to build their trust and align, more importantly, on the expectations. So depending on the size of the board, which the PE firm typically has one or several seats on, I try to connect with one board member a month or every other month. And this is outside of the standard board meeting. And I found that building a strong relationship with the PE firm and board members is very critical to my success as a CFO.
I would agree with you. PE firms want constant communication with you. Yeah.
Constant communication, constant data sharing.
Yes.
And so that leads me to my next pointer is you have to be super strong with your financial acumen. You need to have really strong financial management skills, and you have to showcase a deep understanding of the financial metrics, the performance indicators, and all the key drivers of the business, because this helps to instill confidence in the PE firm of your ability to manage all of the financial aspects effectively. And so I'll sum this up to say, you need to know your numbers inside and out, up and down, and they must be accurate.
I would say this is the most important thing or factor for CFO and working with a PE firm. You just have to know your stuff and know it really, really well.
Yeah, it's the opposite end of the sword, right? So you have the PE firm and they can give you great strategic alliance, but the other end of it is you're working with other financial people and they're super sharp. And so they ask those really detailed questions. So you have to really be prepared to answer them.
Absolutely.
Another good pointer is demonstrate that you can deliver value creation. And so by that, what I mean is demonstrate how your financial strategies can contribute to the overall business value. And that could be by virtue of cost optimization ideas or revenue growth ideas, or even operational efficiency, programs that you put into place. As you do all of those things, as a CFO, you must also manage risk, because the last thing you want is to surprise the PE firm. So you have to have clear insights into the potential risk upfront and be prepared to propose strategies to mitigate them before they become a problem for the business. And one way that I generally do that, Lorraine, and it goes back to knowing your numbers inside and out, is you want to leverage scenario planning. I, particularly with PE firms, more than any other type of business, I always develop and present scenarios for different financial outcomes. So for instance, when it comes to budgeting, I run my base case budget for sure, and that's usually bottoms up, zero-based. However, I will also have in my hip pocket 2 other scenarios. One is a better case scenario, and one is a worst case scenario. I found that this really shows the PE firm that you're already thinking through and preparing for uncertainties, and it demonstrates your ability to navigate through those various situations. Last but not least, cash is king with PE firms. And at
Totally.
least that's what I found. So it's definitely working with PE firms have sharpened my cash forecasting abilities. And I have had to be reminded that you never lose sight of the cash availability when you're working with a PE firm. And you must be prepared to show your cash projections frequently and have those stress tests tested by the PE firm, particularly if you're running with less than 1 to 2 years of cash, depending on the velocity of the business. If you can demonstrate that you have a handle on managing the cash situation, I think that would really signal to the PE firm that you have a clear grasp on the business and your ability to signal to them capitalization needs very early on.
Totally. So, what I'm hearing from you is probably of all of those pointers, the top three are, financial transparency. The CFO has to have that financial acumen that we talked about, right? And then being able to really managing cash, doing those cash forecasts, working with the PE firm, because that is very, very important to them. So great insights into how a CFO should work with a PE firm. Great insights, Monica. Thank you for that. So now we're going to shift to our last subject, which is working relationships with CEOs. So we're going to first start by asking, what's your best experience working with the CEO and why was it so rewarding?
Yeah, well, this is easy. My best experience by far was actually my first CFO role.
Mm,
And the reason it was so good is that I had the privilege of working alongside an outstanding CEO. And why she was outstanding was that she excelled not only at being a people leader, but she was also very strategic and visionary. What set her apart was the culture that she created and fostered because it was very people centric, but it was also exceptionally data and finance centric, which is a rarity, particularly.
this is the CEO you mentioned in the beginning, right?
Absolutely.
The strategic visionary thinker who also wanted to work closely with finance and the numbers.
Yeah,
I remember,
same,
yeah.
same person. And so, and that's a unique culture, particularly in luxury and in fashion, to have to be finance centric and not marketing and
Yeah,
brand centric.
yeah.
And so with that unique culture that she helped to build, it really required my involvement in decision making early on and consistently throughout all of the various processes. And so by working with her, I found that my role was not confined to your typical behind the scenes finance roles like the
Right.
month end close and treasury and all the things us finance people do behind the scenes. But I also was pretty front and center and immersed in the heart of all decision making. We had pretty ambitious financial targets for the business. So this approach really, one, helped ensure that we hit those targets, but it pushed me as a professional and as a CFO to think more strategically about the business. And it really ensured that I delved into areas and intricacies like the inventory buying cycle or the open to buy, as it's called, digital KPIs. Those are just two of the areas that I really had to get from behind the normal, month end close and dig into as a CFO. It provided an opportunity, I would say, truly, that helped me to develop tools as well to support other departments since we were placing data and finance and ROI at the forefront of decision making. And boy, I have to tell you, Lorraine, the results spoke volumes. We achieved our break-even target. And this, if you remember from what I said earlier, was during an economic downturn.
Mm-hmm.
So we were able to hit our break-even targets and we saw double-digit EBITDA growth. We tremendously reduced markdown levels. So while I was going to the fashion shows and that sounded great, I really wasn't at the show. I was behind the scene making sure that we didn't end up with a huge amount of markdown liability at the end of the season. And so we also were able to improve our gross margins. We optimized our marketing spend. And we even went so far as to look at every single dollar that went out of the business. And there we had some significant savings in other areas as well. So this for sure was probably one of the best CEOs I worked with, and it had to do fully to her genuine commitment to providing her team with a platform for growth and for them to shine, but also to create that data and finance centric organization.
Well, that's very unique in a CEO to have both the visionary piece, the wanting to work with finance and understanding the numbers and not fight against them, and then also the ability to um, put his or her personnel or C-level executives, whatever, and giving them a platform to grow and shine. Those are three very unique traits that very few CEOs have all at once. So that,
Yeah.
wow.
Yeah, it's true. And it really, I think, helped to make not just myself, but a lot of the executives better leaders. We were all, I would say, relatively new. It was my first CFO role. And it was also the first time several of my colleagues had been in the C-suite too. But we were entrusted with some pretty significant responsibilities. And the outcomes were evident in terms of, this putting data and performance at the
Sure.
center of all things. We created an organization where every single executive and their teams were very financially astute and savvy. I constantly taught P&L literacy classes, and everyone just gobbled it up because they knew it was going to help them be better leaders.
That's
So
no,
yeah,
I was going to
sorry.
say no. I was going to say that's very, very tremendous that you had that kind of experience. Now I'm going to ask you the opposite question, which is that was an amazing, really positive experience. Tell us about your most challenging experience working with a CEO, and what were the roadblocks and how did you work through them?
Sure. Well, that's an easy one for me to answer too. So most of my roles, Lorraine, have been largely around restructuring and driving profitability or profit maximization. And so as a CFO, you kind of go in there and you know what you need to do to get to those metrics. And so my most challenging role or experience was um, working at a company where I was brought in to do exactly that. However, I was going to be partnering with a first-time CEO to do this.
Mhm.
And while that CEO had a wealth of industry knowledge, they were still navigating the intricacies of making tough decisions. Their approach leaned heavily towards consensus, right?
Mhm.
Seeking out what felt like to me nearly everyone's input on every single decision. There were frequent gauges of employee sentiments, even over decisions that were tough decisions and often should have been confidential decisions like necessary workforce reductions. As a CFO, I found that I had the task of driving profitability, and the need to get consensus from everyone oftentimes delayed our course of action. So it was quite difficult.
And not only
Over
that, but
time,
what if you don't get the consensus? Then you're really stuck at ground zero.
you really are. And so I had to figure out a strategy for working with this particular CEO. And so what I came up with was I realized that our leadership styles did not need to be 100% in sync, but we did need some alignment. And
Mhm.
what that was on is what are the critical decisions that only the two of us needed to make because they would significantly alter the trajectory of the business. And after having, a very serious conversation with this CEO about that, we were able to strike that balance. And that balance were, here are the decisions you and I need to make together, because they are
Mhm.
about driving shareholder value. And then there were other decisions that I felt were less important or would have less of an impact on our path to
Mhm.
profitability. And for those, I continued to allow him, or I accepted that he would take a more universal approach and consensus to the decisions that were being made in those areas. So this strategic alignment over time allowed us to make the critical decisions we needed to make to propel our growth, but also gave him the ability to keep a little bit of his leadership style. We were able to successfully deliver on our profitability goals. And in the end, I found that there were some parts of his own management style that I would later adopt for myself.
Yeah. I have worked with several first-time CEOs in my experience, and I found it extremely challenging because you do have the CEO, the first-time CEO that you described, always driving for consensus, never getting it, sometimes too granular, sometimes not necessarily seeing the forest from the trees. And then you have first-time CEOs who, because they don't know what they don't know, they oftentimes want to hide that because they want to shield, they don't want people to know their vulnerabilities. And then that becomes a whole nother set of negative outcomes because of the fact that they're not working with the CFO in the right way. So first time, CEOs got to get there. There's always the first time for a CEO. And the only advice I would give to those CEOs is lean on your CFO and use them more than you think you can, because they can get you to the right place. So good learning there. So
Very true.
just one last question, Monica, before we finish up. And that is, you've been a partner with us now, I believe, for 3 years, doing awesome. What do you see as focus areas for yourself in 2024 and beyond?
Sure. Well, two come to mind. We mentioned earlier that in the last 12 to 24 months, capital has become less accessible for consumer brands.
Mhm.
And I believe that this is going to be the moment where CFOs need to get back to the brass tacks of driving profitability rather than, what it was in the previous years, supporting growth at all costs.
Mhm.
I believe that my experience in restructuring and turning around and driving brands to profitability will really prove out to be a useful set of experiences for our clients that are looking to traverse these current conditions of needing to extend their capital and cash runway and improve their bottom lines. So I hope to get involved in more of those type of engagements. And then the second is, one of the great benefits of being here at FLG is that our industry focus is very diverse. And I hope to have the opportunity to take the skills that I've honed in the consumer industry and really parlay those into some other industries here at FLG.
And you should be able to do that, because I can take myself as an example. I spent most of my 40 plus, we don't even want to talk about that, 40 plus career in med tech and healthcare, but joining FLG 14 years ago, it's given me a platform to work both in healthcare, tech, and most importantly to me, the whole consumer facing sector, be it CPG, e-commerce, mobile apps. You're going to have that same availability of opportunity. Because I think at the end of the day, here at FLG, if you've got the gravitas of being a really first-rate CFO, you can traverse multiple sectors. So we are delighted that you're with us, and I know that you're going to have that kind of experience. So everyone, thank you today for joining us and listening to the perspectives that Monica shared with us with regard to her CFO experience in the consumer and luxury goods arena. So thank you, Monica, for joining us, and thank you, audience.
Thank you, Lorraine.